If you trade supply and demand concepts, I guarantee you're making at least one of these 5 common mistakes that are absolutely wrecking your results and probably the confidence in your own strategy and your own trading ability when they can be completely avoidable. So today I'm going to show you exactly what those are and how to overcome them so you can completely transform your results. Okay, because what you will likely see is a lot of them are kind of related to each other. So as you start to fix one, you will start to fix the rest of them and it will make a huge difference to your trading. My name is Matt Don-Levy and I am the founder of Photon Trading, and we help people get consistently profitable using the power of mechanical strategies. Alrighty, let's dive into mistake number 1, which is trading from weak structure. Now, it's quite a common mistake, but the good thing is it's a reasonably easy one to fix. So on first glance, if we look at this supply zone, it looks pretty decent, right? It led to a break of structure, which means that a fair amount of money must have come in, right? A fair amount of supply in order to achieve that, a decent amount of momentum. Arguably there's a bit of a mini double top there, so we can say that it has potentially swept some, a decent amount of liquidity there. So it looks pretty decent. So why is that failing if you're looking to get short here and price is blasting straight up? And that's because you need to zoom out and look at the bigger picture and realize that the overall trend, swing trend, is actually bullish. You don't even need to be doing multi-time frame analysis or anything like that to see that, right? If we zoom out at the bigger picture, we can see that price is starting to make higher highs and higher lows. Price has already pulled back. So now when price is coming up towards this high, this is a weak high, right? Because it's failed to take out the swing low. So now you're trying to short against the trend. So if I zoom out, all right, what you will see a lot of the times is people are continuously trading from weak structure, right? They'll be really zoomed in this area thinking, this looks like a pretty decent supply zone. It led to a break of structure to the downside, a lot of momentum, and they're looking to get short from here. But what do? They get smashed. Why? You're trading from weak structure, right? This is the swing pullback. The pullback is now complete. And now we're ready to do what? To take out the weak swing high, but you're trying to short from here and are getting smashed, right? For those of you who have watched some of our old videos, you should be quite familiar with these diagrams where how do markets move when they're bullish? They pull back and then they target the weak high, right? Supply and highs we expect to fail, right? We pull back to demand, and then once that pullback is complete and we're moving to the upside, this is now a weak high. Why is it weak? It's failed to do its job. It's failed to break the low. This is a strong low because it's broken the high, right? So when price pulls back into that strong low, we expect the low to hold, we expect demand to hold, and now when that pullback is complete and we're making that next swing leg to the upside, this is a weak high, we expect that supply zone to fail, right? And so on and so forth. And then, the reverse for supply, right? The highs are strong because they break structure. So when price pulls back up to them, we expect them to hold, but we want to target those weak lows where supply is. Okay, so it's a simple concept you can get your head around. But obviously in the markets, when you get more complex scenarios and you can be trying to trade the internal structure, right? After prices pull back up here, then you're trying to short here. The objective is complete, right? You're shorting against that, and price now wants to target that weak structure. So, when you go back to the realities of the market and the way price moves, a lot of basic mistakes is people get caught up in this. Again, trying to short from levels like this, looks like a lot of momentum come in, but it's a weak high. Prices pull back, and now we're ready to take that out, take out the weak high and make the next movement to the upside. Again and again and again. And people you wouldn't believe it how often they get caught on the wrong side, trying to short from these highs, right? Trying to short from these highs when they haven't broken any structure, right? We pull back. These are now weak highs. This high has failed to break the low. It's weak. Price smashes through it and then eventually smashes through there. So that's mistake number 1, trading from weak structure. Quite a simple one to fix in my opinion. You just need to not be too zoomed in and understand what the bigger picture is. So mistake number 2 is trading against the objective. And this actually follows on quite closely from mistake number 1. Okay, so if you remember, mistake number 1 was trading from weak structure. We don't want to do that. We want to do the opposite. So what's the opposite? Of course, we want to trade from strong structure and target weak structure. Okay, so that's a simple rule. We want to trade from strong structure. But when does it make sense to not do that? When should we avoid trading from strong structure? And this is an example of when you know to do that, and it's when you're trading against the objective. That's when you want to avoid trading from strong structure, and I'll show you what I mean in a minute. Okay, so imagine the overall larger swing trend is bearish, right? This strong swing high took out the low. So now what do we expect? We expect that swing pullback to occur, but we expect the strong swing high to hold, and then we expect that bearish swing trend to continue and to target that weak low. Okay, now we can play the movements within that swing pullback, right, we can follow the internal structure. So when that internal structure shifts bullish, these internal lows become what? They become strong because they broke the high. So when price comes back in, we can look to buy that. Why? Because we are trading from strong structure, and we are targeting weak structure, right? This is a weak high because it failed to take out the low. So we can get in long here and target that high, right? And we can keep doing that. Again, buy from strong structure, like this range. We might not come all the way near the low. We might mitigate something higher up in the leg, but we're still following the same principle from strong to weak, okay? So that's fine, and we can follow that, okay? And then we get another eyeballs here. This is a strong internal low because it broke the high. So when price comes back, just like before, should we look for longs to continue that movement? Well, this is where you have to ask yourself these two questions. What is the current objective and what has been mitigated, okay? So if the swing trend is bearish, but the internal trend is bullish, then what is the objective at the moment of the internal structure? The objective is to play the swing pullback up to premium supply. So at this point, when we've mitigated premium supply at the strong swing high and we're coming back down, the objective is already complete. The reason why the internal structure shifted bullish is to facilitate that swing pullback. So if we've already got to the area in which we expect the swing pullback to end, where we expect that swing lower high to form, and we expect that next bearish leg to continue, then it's very likely the objective is complete. So what is likely to happen next to the internal structure? It's now likely going to switch bearish, right? Because the swing pullback is complete, and now it's ready to start that next bearish swing leg to the downside, okay? So if you realize what the objective is, and realize it's likely complete, and then ask yourself, well, what has now been mitigated? Well, the extreme supply at the strong swing high has been mitigated. Now you can know that this is a good time to not buy from the strong internal low, right? Because now it's likely going to break because it's done its job. This has been mitigated and now we're ready to go, okay? So the whole point of this mistake, the thing you need to look out for is, yes, we should always be looking to trade from strong structure and targeting weak structure. And in this scenario, yes, this is a strong internal low because what did it do? It broke the high, but you need to look at the bigger picture. It's done its job. The objective is complete, right? Because we've had the swing pullback up to premium supply. What's been mitigated? Premium supply has been mitigated. So it's likely now, if that bearish swing trend is going to continue, this is the area which it's going to do so. So therefore, that's when you can expect the internal structure to shift bearish, right? And that's when we want to go. So if you take a look at a few examples on the charts, I'll show you what I mean, okay? So you can see here, we zoom out a bit, the larger swing structure here on the M15 here on euro dollar, okay? So these are the larger swings in price, right? You can see the lower lows and lower highs, but what do we have within that? We have the internal structure, okay? So just kind of loosely follow this here, but you can see the larger swings from within here, okay, as it facilitates that pullback. So at these moments, right, we can look to trade within here. I know I'm a bit zoomed out, but you should still be able to get the picture, right? The objective. We can buy these higher lows, these internal lows, but we're doing what? We're trading the swing pullback. So when the swing pullback has pulled up to the premium of the current range, right? If you draw on from the high to the low, I know it's a bit faint, but hopefully you can see that, right? It's above the EQ, above that line. We're now in premium. We've mitigated that previous swing range here. Okay, so we know this is supply. That's when the probabilities of the swing pullback finishing are quite high, and we expect that next bearish leg to the downside. So yes, initially when we're playing that swing pullback, that's when it's high probability to be looking to buy these internal higher lows. But once we've got up to the premium of that previous leg, right? Yes, this is a strong internal low. It broke these highs, but you see now the objective is complete. So now we expect that low to go, right? We expect the internal structure to shift bearish. And this is where I see a lot of people taking losses from within here. The two zoomed in, seeing that go and thinking that's going to continue. And of course it could continue, but you have to understand why the probabilities are now a lot lower, okay? And you know, you'll see it time and time again, where again, we get another break of swing structure. So this is our swing high, this is our swing low. And we can do what? We can look to follow and buy these internal high lows, right? Trade from strong structure, target the weak highs. But eventually, what happens? We pull back up to the premium of the leg, right? If you draw on the premium discount, we're up in the premium now. We've mitigated premium supply to the left. You can see price is struggling to break those highs, right? We're sweeping all that liquidity to the upside. You're starting to see that recent order flow switch bearish. So technically, that was the last IBOS there. So this is your strong internal low. But if you try and buy from here, the probabilities are now a lot lower. Why? Because it's done its job, right? The internal structure has pulled up to premium supply near the strong high, near the strong swing high, and now we expect it to fail. So this is why you don't want to be trading against the objective, okay? And you'll see it again and again. Just a few more quick examples, right? That's the swing high, that's the swing low. The internal structure shifts bullish to facilitate it. But what do? We pull back up to the premium of the leg. We sweep the liquidity behind these equal highs here to show you that there. Liquidity grabbed in the premium. Previous supply range has been mitigated. Okay, this is the previous supply range here. Objective is now complete. It's very likely this strong internal low is going to fail because it's done its job, right? The pullback has been complete again and again and again. Same range here. There's the high internal structure. That's a strong internal low, but what have we done? Swept liquidity, pull back up to premium supply, internal structure now shifts bearish, and we go. So this is a low probable level to be buying from, okay? So that's mistake number 2. We want to avoid trading against the objective, and that's when you can anticipate that strong structure is about to fail. Alrighty, so that brings us on to mistake number 3, which is having the wrong expectations of price, okay? And I'm just going to quickly use the same diagram from the second mistake to help us explain that. And very simply what this is when price comes into a supply demand zone, we can look to trade from it and we can trade the reaction, but people have the wrong expectation of how far that reaction is going to go, how far price should move from that zone. And what I mean by that is, you know, let's say we have this internal range here to the upside. There could be multiple supply zones within this range, right? That might be a demand zone down here. But as you can see, price may not pull all the way down to this demand zone initially, right? We might come up and reject from this one instead and continue, okay? And that's fine. But now, when the internal structure shifts bearish and order flow is bearish, okay, what people do is they'll look for these supply zones to the left that are unmitigated fresh zones, and they'll look to buy from them. And of course, that's fine. But you have to have the right expectation that when order flow is bearish, all demand zones to the left are just reaction points for pullbacks, okay? So it's just a pullback to supply to then continue lower, okay? Demand zones, when order flow is bearish, are just reaction points for pullbacks, okay? So you don't want to be getting along here and trying to expect that movement. That's not going to happen. It's just going to be a reaction to supply before we go lower, okay? So a few examples here on the 4-hour chart, right? When the 4-hour chart was bullish back here, okay, these demand zones are coming to the market and they're not mitigated, they're breaking structure, order flow is bullish, so we can look for price to pull back into them, but it's obviously not always going to do that. So these are fresh demand zones that are left here. Now, when the trend and order flow shifts bearish and we start coming down, we can look to trade from all of these old demand zones to the left. But what do they say? When order flow is bearish, what do we expect from old demand zones? They're just reaction points for pullbacks. So as you can see, when price is coming down, you can look for longs from within here, right? Maybe on a lower time frame, etc., etc. But you just have to understand it's just a pullback into supply, right? Again, reaction point, just a pullback. Reaction points, just a pullback into supply, right? Supply is in control. These highs are going to hold. So you just have to understand that this is riskier and you're just playing quick pullbacks. And then likewise, back when we come over here and order flow shifts bullish, right? We get that shift in structure. Supply has now failed. What do we expect of these supply zones to the left, right? They're just reaction points for pullbacks. We'll quickly draw this on. Okay, so when we get that shift in order flow and we get that shift in structure, we can short from these old supply zones, but we have to not expect what? We're not expecting new lows because now the low is strong and we're just playing the reactions into demand. Demand is in control now, okay? So you can see demand holding. And then what do? We don't want to be shorting from the weak highs, do we? Mistake number 1, because we've pulled back and now we want to target past that high, right? Again, pull back into demand, target past that high. Old levels of supply, what do they become when order flow is bullish? They're just reaction points for pullback to where? Back into demand because demand is in control, right? And then what do? Target the weak high. And then again, old levels of supply to the left. What are they when order flow is bullish? They're just reaction points for pullback. So again, you can look to short from here, but order flow is bullish. So you're just trading back into demand. And then what do? We target the weak highs, okay? So these are things that you almost want to be learning on day one. They're sort of the basic way that the market moves. But again, when you're getting caught up and you're too zoomed in, you're looking at multiple time frames, sometimes you can kind of lose grip of these facts, right? So that's what I was saying at the start. If you kind of fix one of these mistakes and kind of get your head around the frameworks that we use, the mechanical frameworks, they all kind of solve each other. And then suddenly everything clicks, you have those aha moments, and it all becomes a lot easier. Alrighty, that brings us on to mistake number 4, and that is trading from zones that have no inducement, okay? Now, liquidity, it's a massive topic. I'm not going to go into it in super depth here, but I'm going to try and kind of go over this very, very high level and quickly to fit in with this video, and hopefully this should help. So very simply, zones that have no inducement, it's basically a fancy way of saying there's no available liquidity in front of the zone, right? So if you were to look at the zone initially, you might think, right, well, you know, it just about led to a break of structure. Big amount of supply must have come into the market there, right? Tons of momentum. It looks super clean. So why has it failed, right? Likewise again here, another clean zone led to a big bullish push. I'd definitely expect that to hold maybe. Why has it failed, right? And it's to do with the idea of inducement, okay? So give you a quick crash course. So the easiest way to think about this is just imagine for a minute that you are a massive institution and you need to put huge orders through the market, and you want to buy, you want to get long. What do you need? You need people who are selling to you, right? Because for every buyer, there must be an equal seller, right, for a trade to take place. So imagine if this was the order book where, you know, you can see the amount of liquidity at each price level, and let's just say you wanted to put $700,000 long right through the market. Well, there's only 500,000 at this level, then that would be 600,000 filled. So price would have to jump all the way up to here, right, to fill your order. So when you're getting long, you want to get long, right? You want to buy at the lowest price possible. You don't want to get slipped when you enter the market and have to get your price filled all the way higher up, right? You want to get in as low as possible. So if you are a big market participant, where are you going to want to transact? You're going to want to transact if you're buying where there are tons of sellers, right? When there's that opposing liquidity, okay? So this whole idea is we want to find those areas in the market where there's going to be opposing liquidity, where we think that those big players are going to be trading in the opposite direction. And that is where the idea of inducement comes in, okay? And inducement is essentially encouraging market participants to generate liquidity in a certain area, okay? So anywhere where you see lows in a market, so obvious equal lows, or say like a low that actually broke some structure, what is that going to do? It's going to induce sell side liquidity below those lows, right? For multiple reasons. If you see obvious double bottoms, or if you see a low that broke a high, right? People are probably going to want to buy from that level, right? Buy from the support level or buy from that low, right? When they see that trend change, they're going to buy there. So if you've got long, where the stop loss is going to be, it's going to be below the lows, right? Below that low that broke the high, okay? And that's going to produce that sell side liquidity. Or some people will see, right, well, that's a strong level. So if we break below that, I'm going to want to sell the breakout, right? So both scenarios, for whatever reason, when you see either, you know, very obvious lows or a strong low that broke structure, it's going to induce and generate sell side liquidity below those lows. So again, if you're a big guy and you want to buy, and what do you need? You need that opposing sell side liquidity. Buying below those lows where those opposite orders are is going to be an area in which you can get your orders filled without having minimal slippage, without price having to shoot all the way up to the upside to get yourself filled, okay? So if we come back here and if we think, okay, this is a supply zone that we think big players stepped in to sell. So when price returns there, why did it fail? Well, what do they need? They need opposing liquidity. They need there to be buy side liquidity below there for them to sell into. But look, there's a straight push. There's no highs in that leg, right? There's no liquidity. There's nothing here. So if there's nothing here, and if there's nothing built to the right, there's no strong liquidity built here, where is the available liquidity? It's only behind the high itself, and that's why we see it fail. Likewise here, if the big guys are going to be buying from here, what do they need? They need a structural low in front of there, and there's nothing built here to the right either. So there's no liquidity built. So where's the available liquidity? It's below the low itself. And that's why you then see this zone has a much higher probability, higher probable chance of playing out, okay? Now, there are other factors at play, right? This zone directly led to a break of structure. It flipped this level of supply. This one is well priced, but we have to combine all of these confluences together, okay? But you want to be looking at zones that don't just have those straight pushes, that have some available liquidity in front of them, and just look for where there are lows, okay? Because otherwise, look at this supply zone right here. Straight push down. No available liquidity there, nothing here. So where's liquidity? Behind the high itself. And that's when you start to see some selling pressure come in. Likewise here, straight push, right? Nothing built here. There's no structural lows there. Nothing built here. Price takes the liquidity below where? Below these lows. And then the long moves occurs, right? Because there's enough sell side liquidity for the big guys to, in theory, buy against. That's supposed to be a dollar sign, but I'm clearly not an artist. And then we see the real movements. Okay, so that's what I'll say on that topic. There is a ton more detail to dive into that. We have probably about 10 or 15 lessons in the course that we have, hours and hours. We go into this in deep. We have mechanical models for what to do in every single scenario, mechanical ways of defining what is and isn't strong liquidity, mechanical ways of knowing exactly whether that inducement is near enough to the zone or not. So if you're interested in that, we'd love to work with you. Give us a shout at photontradingfx.com, and that is the plug for today over. So yeah, that is mistake number 4. No available liquidity in the leg, right? No inducement, and very often those zones will fail. Alrighty, so the 5th and final mistake is trading continuations after a break of structure. So if you've had the pleasure of watching any of my previous videos, a thing I talk about a lot is after a swing break of structure, what do we expect? We expect that swing pullback, okay? So every time, if you just quickly look back, we get a break of structure, we get the pullback, right? Break of structure, we get the pullback. Break of structure, eventually we get the pullback. Break of structure, we get the pullback. I think you guys get the drill. But what happens is when those highs go, that's when people go, oh, we're bullish, we're breaking highs, and they kind of almost FOMO into longs or start trying to target really, really far. And we almost want to be doing the opposite. We want to go, okay, that high is gone. Now I need to start thinking that at any moment that pullback can kick in. Now, the kicker is sometimes, this is a perfect example, price won't pull back straight away, right? And it will go on for a fair amount of distance. So I'm not saying you should never trade a continuation after a break of structure. Of course, there is an edge there and you can do it. It's just more often than not, you'd be better waiting, in my opinion. I feel like you should earn the right to know how to trade, keep trading that direction after a break of structure, right? Because again, look, we break the highs, we retrace straight away, right? These zones start failing, we pull back to discount, and then we go. This is when you want to start looking for the longs. As soon as the high breaks, you want to start thinking more about the pullback, okay? So when can you do it? So there's a few things you can think about, and it's here, okay? So the start of a hard time frame reversal. So very often what you'll see is, say we have a bearish trend for quite some time, and then you get that initial trend change where we switch bullish. I have typically found that not always, right? There's obviously going to be exceptions to the rule, but more often momentum will be quite strong when that first happens. And that's when I'm a lot more willing to, on a lower time frame, keep trading those continuations until that lower time frame order flow shifts. And then when it does, okay, now that swing pullback's likely going to continue, right, on the higher time frame. So at that start of that initial hard time frame reversal, that's when I'm often willing to be a bit more aggressive with trading those continuations until you get that lower time frame order flow shift, okay? And also what I'm looking to do with that is the second point. I want there to be clear internal structure. So imagine this orange line was the 4-hour chart, right? And we get that shift in the 4-hour bullish trend. On a lower time frame then, on the M15, I'm going to be looking for clear bullish ranges within there to trade, okay? If it's kind of just shooting up in the vertical line, I'm not just going to FOMO into it, or like the M1. I'm going to need to see clear ranges, clear demand zones on the M15, right? And I'm just going to be looking to get in, target the high, get in here, target the high, quick little moves in and out, and just following that order flow, okay? So ideally the start of the hard time frame reversal, clear then internal structure on a lower time frame to work with. Then the next one, no nearby key levels. So ideally, you don't want to be trading against a major supply zone, right? Something like that, because of course, we're going to expect a bit of a pullback to kick in from then. So obviously try and do it where there's no nearby supply zones to the left, unmitigated supply zones. And like I said, just have quick targets in and out, because at any moment that pullback can occur, okay? So this is quite tricky for some people to kind of, I feel, accept psychologically, because, you can understand that in theory, and then when you get the break at the high and you just see it going up and up and up and up, you get FOMO and you start FOMOing into positions. Whereas if you just wait for the pullback, like I spoke about earlier, wait for price to pull back into the EQ of the leg, into a high probability POI, right? This is the one, I need to change my settings here, but that broke structure, that flipped the level of supply, that has inducement, that swept liquidity, all of the concepts that you can use, you can be patient. But from here, when we break out, to here when we get tagged in, that's 3 days and 4 hours. For a lot of people, that feels like an eternity. And they start doing dumb things like forcing trades up here, trying to buy the highs, trying to keep thinking we're going to go up and up and up, where they're not realizing how overextended we are. If you look left, we've come into a fresh supply zone, right? That's what I mean, a nearby key level, right? And then we pull back. It's just be patient. Then when we get in here, now be aggressive with your longs, right? On a lower time frame, start following that M15 bullish internal structure, target the week high, right? That's what we do. So They're the 5 key mistakes. So let's wrap this up and summarize those 5 key mistakes you should avoid. And that is trading from weak structure, right? We want to be trading from strong structure, targeting those weak highs, right? You can see again and again, all of these weak highs are failing. Why? Because the overall trend is bullish. And after those pullbacks have been completed, well, that's when we want to target those highs. Pullbacks complete, target those weak highs. Easy mistake for you guys to avoid, okay? Buy from strong structure, target weak structure. Mistake number 2 is trading against the objective. And this is where you think you've done the right thing. You've bought from strong structure, right? That broke the high there. But why are you buying from here? Why does it end up failing? And it's because the objective is complete. What has been mitigated? We've mitigated premium supply. We're expecting the swing pullback to now be over. So what do we expect? We expect that strong low to fail, and we expect the internal structure to shift bearish, okay? And we went through tons of examples here. You can see once we get those swing pullbacks up to the premium levels of supply in the premium supply range, that is when the internal structure shifts bearish. All right, we break those lows and we go again and again and again. I'm not going to go through all of those examples. The third one is having the wrong expectations from zones, okay? So this is a perfect example. Once order flow shifts bearish, right, old demand zones to the left, what do they become? They just become reaction points for pullbacks, right? We're not expecting new highs from here. They're just quick pullback plays, which is what we see here with all of these pink/red zones, right? Order flow now shifts bearish. So all of these old zones, they're just what? Reaction points for pullbacks. Once order flow shifts bullish here, supply is what? Reaction points to demand. Reaction points to demand, okay? So manage your expectations depending on the current trend and order flow. Fourth mistake was trading from zones that have no inducement, right? So there's no available liquidity in front of the zone. So try and avoid these ones with straight pushes and no liquidity has been built to the right, then the only available liquidity is behind the high or low itself. Likewise here, straight push. So that's what gets taken. The liquidity is used below those lows, and then we get the real movement, right? Straight push here. Where's the liquidity? It's behind it. Then we get the real move, okay? And then last but not least, try and avoid trading continuations after the breaks of structure. You can do it. I'm not saying you shouldn't, but it's kind of one of those ones that I think you can avoid until you're consistently profitable, waiting for those pullbacks and then getting involved. For the most part, you're probably going to get burnt buying after the highs. Can do it. Of course, there are breakout strategies that work very well, but you just need to make sure that it's well within your edge, okay? So the things that has helped me with that is the start of the hard time reversal, clear lower time frame internal structure then to work with, no nearby key levels that you're trying to trade against, right? Not trying to buy against old levels of supply, and you just have those quick targets, right? You're not trying to target miles and miles away, just in and out, target the nearest weak piece of structure, and you will do well. So if you want to level up your game and start taking this really serious, we have an amazing library with our full end-to-end course that takes you through everything from A to Z. Even if you have absolutely zero knowledge, we cover everything: psychology, risk management, etc. We go in tons of depth in our course here, right? There's tons more lessons behind these levels here, especially liquidity. I know a lot of you are keen on that. We have a load of lessons in here really going in depth. We have full backtesting walkthroughs. We've got tons of backtesting stuff within here. You know, we also have this where we upload daily market content. We've got meetups, backtests. Every single day after the London session, I do a full breakdown, recapping any trades and the price action. You know, a lot of our members have thanked this for being a massive improvement in you know, how they've been able to apply the concepts to their daily trading. So if you're ready to level up, click the link below in the link of description, and I look forward to you. So see you in the next video, guys, and enjoy.